Okay. Right. So good afternoon, everyone. For those of you who don't know me, my name is Christina Caprina, and I'm the Chief Economist and Portfolio Manager at Sequoia Wealth Advisors. And we do these webinars approximately once a month just to kind of give everybody a bit of an update on the economy, what's going on. Not so much projections that sometimes are really helpful, but as you can all imagine, everything's changing pretty rapidly right now. So please do timestamp that whatever we say today, March 11th, 2025 is subject to change. Because again, in a normal times, things change, but things are changing quickly now. So I just want to kind of timestamp that a bit. Many of you have heard Brian Nash speak before. So for those of you who haven't heard him, Brian Nash, you can see here on the screen, he is a VP at Goldman Sachs. He has spoken at our events, both live and in person, a number of times in the past. And he's an excellent presenter on the state of the economy as Goldman Sachs view. And thought with everything going on in the world, you wouldn't just hear Christina, you'd also have an opportunity to hear Brian. So what we're going to do here today is I'm going to go off screen. I'm going to be here. I'll let Brian talk. He's going to talk a half an hour or so, just depending on how much information he wants to share. Any questions you have for Brian, please put them into the Q&A, because afterwards I'm going to pop back up when he says he's done or when he takes a break for questions. And then I'm going to ask the questions. So get your questions ready, make sure to get them out there, and both Brian and I can answer them kind of back and forth, or you may have a question for one of us. After all that's done, depending on how many questions we have, I'll kind of fill in the gaps, anything didn't come up today, any other things going on, and kind of a little bit of the Christina update. So with that being said, without further ado, Brian Nash, VP of Goldman Sachs, Economic Outlook, which he just mentioned to me, they just updated yesterday, so it's going to be really fresh. So, okay, here we go, everybody.
Great. Thank you, Christina, and thanks for everybody that's taken some time here midday to hear an economic update. I've worked with Sequoia Wealth going on, gosh, almost 14 years, and it's been a pleasure working with Christina and the broader advisor group there. And so know that you're in very good hands as you think about the markets, as you think about your life situation and what you're trying to accomplish. The goal today, again, over about a half an hour, I want to share the latest thinking from Goldman. We'll get into what are we thinking about the economy. How does that, affect our outlook for the overall markets, both equities as well as fixed income? But we want to tackle some of the tough stuff, like how are we thinking about tariffs? How do tariffs affect the Mag 7, which is clearly a big part of the overall market? And so the goal is to answer, I certainly won't answer all of the questions in the preamble here, but hopefully we can hit some of the high points. And again, as Christina mentioned, if there are things that we don't cover, happy to try to cover them in Q&A. Look, if I start here, and this is just an executive summary, what I'd like you to look at, and if you can't see very clearly, let me just get to a full screen. Oh, you know what? We are in full screen mode. Apologies.
Brian, may I interrupt for a moment?
Yeah.
Is a lot of people register and don't attend live. We have 200 something registrants. So
Okay.
Is this something that we can share, you can give to me and I can share with people participating afterwards, or is this only for firm use?
The deck's end client approved. So
Okay,
anybody can access it. I'm happy to share it following the meeting today.
Great. So anyone who wants it, just shoot us a message and you will get a copy of this so you can read it at your leisure. Okay, sorry about that.
No problem. And actually, the one I just had pulled up, bear with me 1 second. All right. As we literally changed the deck, I realized that I had up yesterday's or the last version here. And so I'm going to pull up the March snapshot, which we updated again on Monday. And the reason we updated it is, with so much regulation in the news, as you're thinking about new policy, tariffs, how we're going to interact both with countries like China, where maybe it's a bit of an adversary, but also, our primary trading partners, Mexico, Canada, Europe. There's a lot in flux as it relates to what our policy may look like moving forward. And so what happens with that is that can impact our expectations both on growth as well as inflation, which can then influence, either the optimism or pessimism in the stock market. And clearly, the markets have been very volatile year to date. They've been very volatile this week. And a lot of that is the market trying to find its footing as it relates to what policy might be. The challenge is, as we sit here today, Goldman Sachs does not know the policy moving forward. Sequoia doesn't know the policy moving forward. We have a decent understanding of historically what's happened, but history is only a guide. It doesn't necessarily mean that's how this will play out. And I think everyone is probably pretty clear on that at this point, given the headlines we've seen year to date. But again, if you want to start here just with the chart box in the upper right, what this is looking at is 2020 or is current data along with our 2025 forecast. And just very simply, if you look at the dark blue and the light blue, at a 30,000 foot view, what you see is not a lot of change. And I think that can be viewed as a good thing. When you look at GDP growth, last year we grew at 2.3%. We expect us to grow at about 2% this year. That said, we just downgraded that from 2% to about 1.7. And I'll come back to that. On inflation, core PCE, this is how the US Federal Reserve measures inflation in this country. Last year it was at 2.8. You can see we had a 2.9 print. However, we updated that yesterday to 3.1. And so again, there you can see a couple of moving pieces. Growth getting a little bit lower, inflation moving a little bit higher. Both of those have been driven by the expectation from our firm that tariffs may be larger than we originally expected. And so that's where you can immediately see an implication to economic data based on what we're hearing coming out of Washington. Fed funds rate. This is short-term interest rates. This is what the US Federal Reserve generally can control. Here you can see it's currently at about 4.4%. Goldman Sachs has 2 cuts priced in for this year. At June, a 25 basis point cut. At December, a 25 basis point cut. I can tell you, if you were looking at the market expectations, about a week ago, the market was saying maybe 1 cut. Today, the market is saying likely 3 cuts. So you can see how much economic data is moving. As it relates to longer rates, so this is looking at the 10-year Treasury, there we feel it's pretty well anchored. Now, current rate is actually 4.2. We think that's roughly fair value. So the long end of the curve, we would expect to stay relatively steady based on our baseline outlook of no recession. Now, if we were to go into a recession, you would expect long rates to fall. And I'll come back to kind of what that'll mean for your portfolio. Now, as it relates to the S&P 500, we obviously had an amazing year last year with the S&P over 25%. Here you can see for this calendar year, Goldman Sachs's base view remains constructive. Based on the starting point of the beginning of the year, we see about 12% upside in the S&P 500. All of that fueled based on earnings growth, not necessarily what's called a multiple or price expansion in the market. So again, 30,000 foot view, the data feels pretty good. We don't see massive adjustments, but as I kind of shared in between, we're already seeing policy adjustments take place based on what's coming out of Washington. And more so than anything else, that's what's creating a lot of consternation in the market. Now, let's drill into that a little bit more, looking specifically at inflation. And so I'll try to zoom in here a little bit for you. If you look at the chart in the lower right-hand corner, whoops, jumped ahead a page. We actually have about 8 different potential inflation paths, depending on how tariffs are implemented. We zeroed in on about 4 of them here just to keep the chart a little bit easier to follow. But you can see if we didn't have tariffs at all, and this was just a normalized market, our expectation on inflation would have been in dark blue. And what you would see there is, call it by about the end of 2025, we would have had inflation targeted at 2.1%. So again, the Fed's goal is for 2% inflation. We know we had sky-high inflation coming out of the pandemic. We've been working on bringing that inflation lower. And we would have seen that close to the Fed's target without tariffs and policy that have kind of come up here post-election. Our original expectation for tariffs was that it would increase inflation by about 50 basis points. And so here you can see our previous baseline would have had inflation at about 2.5, 2.6% at year end. But now you can see with our latest forecast of increased tariffs on likely more goods, potentially high tariffs on direct major trading partners like Canada and Mexico, it has taken our inflation expectations to another level where now our baseline view is 3.1% at the end of the year. So in only 3 months, we've increased our inflation forecast for year end by about 100 basis points. We've decreased our growth expectations. Again, if you were to say, Goldman, what is your GDP growth forecast for 2025? If you would have asked me this pre-election, our answer was 2.5%. It is now 1.7%. And so tariffs in general are inflationary. Most of that increase in prices typically gets passed on to the consumer. That can lead to less spending, which leads to lower growth. So a lot of this is a trickle-down effect that ultimately will slow growth, but also increase inflationary pressure in the country. And so again, moving parts here, but hopefully that helps you understand where the inflationary pressure is coming and why we're upticking that, and why we're also maybe getting a little bit more conservative on our expectations for growth in the United States. Now, to be clear, thinking about 1.7 GDP, when we start talking recession, the definition of a recession is 2 negative quarters of GDP in a row. So 1.7% growth is certainly slowing from last year's level of 2.8, but it's also still quite a bit of ways from a negative GDP that would start the potential, again, first quarter driver towards that quote unquote recession. And so, we still remain in the camp that the US economy is on pretty stable footing, but the reality is there is the what we would call left tail risk that tariffs could grow even more, that these could potentially not be just a negotiating tool, but they could be implemented. And if that were to take place, there is another level up on inflation risk. Here you can see the risk scenario where inflation doesn't just go to 3%, it could go as high as 3.3 to 3.4%. That would push our growth numbers down to probably 1.2 to 1.3. And so we're on a slippery slope here. Growth is slowing, inflation is rising, but it's coming off the back of a pretty darn strong economy, a pretty darn strong consumer. And so we're coming from a position of strength, but this definitely bears watching as risk starts to build into the system. Now, you look around the world on GDP, you can see growth, again, assume US GDP now at 1.7, in Europe about 0.8, Japan, UK, China. In general, US growth is still pretty good relative to the rest of the world. And so in general, globally, we're not seeing a recessionary environment. We expect the world to grow at the traditional productivity level, which is about 2.6%. US growth is growing a little bit below potential being 2. And so again, growth generally is in a pretty good spot, but policy is impacting it here in the early days of 2025. Excuse me. Now, when we think about the Fed, we talked about the inflation target trying to get to 2%. The Fed's going to be watching growth. The Fed is going to be watching inflation. That's the dual mandate. Now, when we look at our probably biggest concern in economic data, or one of the things we're watching the closest internally, it's the labor market. Now, if you look at this chart on the right, if you did any of the calls that Christina and I held back around the pandemic, one of the things you had heard myself talk about in Goldman Research is the jobs to workers gap. How many jobs do we have outstanding in this country relative to workers willing to work? And what you can see right here is in March of 2022, we had a significant amount of jobs. We had about 7.5% jobs opening rate relative to only 4% unemployment. Said another way, we had about 6 million more jobs than workers willing to work in this country. So workers had a pretty stable job. They had the ability to fight for higher wages. You can see what's happened over the last 3 years. The job boards have shrunk massively. That jobs open relative to workers willing to work, that gap has gone from 6 million down to 1 million. And so that's okay. But as you can see here, historically, when the job boards shrink this far, the next thing that happens if they shrink even further is you're going to start to see the unemployment rate rise. And so one of the things we're watching very closely, non-farm payrolls. Do we see payrolls coming in between 150,000 and 200,000? If that's the case, the economy is going to be doing fine. If we start printing sub 100,000 non-farm payrolls, you're going to start to see more pressure seep into the market and into the economy. And so, right now, again, generally growth is strong enough. The economy is on relatively stable footing. But one of the things that could be a knockoff effect of these tariffs, and not just having a tariff, but frankly, a lot of the back and forth, putting on tariff, taking off, these negotiations, is it can create gridlock for companies. Think about a company that may want to do CapEx or may want to hire another 50 people. Yet they're worried about, is there going to be a tariff put on their industry or not? That may slow hiring. That may stop hiring. That may slow CapEx. That may stop CapEx. And so this can begin to influence companies and how they're going to interplay with the workforce. And so we get asked all the time, like, what is Goldman watching? Watching the labor market is going to be a critical portion moving forward on, is the workforce stable? Is the consumer strong? Because I'd say over the last few years, one of the shining lights in this economy has been the U.S. consumer. I can't tell you how many headlines have been out there about the near death of the U.S. consumer, the consumer about to roll over, and it just hasn't played out. Now, at the start of the year, we had real income growth. So growing income above inflation coming in at 2.5%. Can that hold? Are companies willing to increase income if there's unknowns around tariffs? And so these are some of the things that can muddy the waters a little bit as we're looking at economic data. Again, right now, everything's in good shape, but if we see further job cuts, likely this starts to affect the unemployment numbers. We're kind of covering policy. I can come back to some of that. When you say, all right, so we've seen some of the rockiness in economic data, albeit coming from a very good place. How does this impact the equity markets? Now you can see here, to start, we're 3 months into the year. Goldman's been dead wrong 3 months into the year as you look at equities. Now, we're always going to take a long-term view. There's going to be whipsaws in the market. I'd say over the last 5 years in general, the research team's done a really good job in the overall outlook. Now, when you look at this year, I think what's really important to just look at first is this dark blue. We are in an earnings-driven market. The dark blue signifies the earnings return in Asia ex-Japan, Japan, the US, global equities in Europe. And what you can see here is outside of Europe, we believe most of the overall stock market returns will be driven by earnings. And look, if you look at last year in the United States, the market expected US earnings to be up by around 8 to 9%. US companies blew it out of the water. Last year, earnings were up by close to 13%. And so, as much as some of the data is scary today and there's unknowns around policy, the reality is US corporates have delivered. The US consumer has continued to deliver. And with growth at 2.8% last year, you can understand how we had such a good market return. Now, we don't see a lot of multiple or price expansion in this market. Coming into the year, the US market at a 22.5 forward multiple. That's not cheap. And so, how do we see the market expanding? It's by earnings. And so, again, good number at 6,500 gives you a low double-digit return. You can see that in general, we see pretty constructive returns everywhere. In Europe, slightly lower, although we did just upgrade Europe by about 2% over the last week. Now, what I would tell you about equities in general, this is a bottom-up market versus owning beta. Not to say having ETFs and beta exposure isn't fine, it absolutely is. But in terms of where you're going to find the alpha, it is going to be company by company. It's going to be stock by stock. If you look at, we all know about the Mag 7. I think what's really interesting, if you look at the collective return of global equities over the last 50 years, the majority of the returns have been driven by 3% of the market, 3% of the overall market. And so you need to find the winners. Now, that might sound like passive is bad. It is not. One of the things John Bogle, who is the founder of Vanguard, the famed passive investor, used to say is, if you're looking for the winners, if you're looking for the needles in the haystack, you know what you do? You don't try to find the needles. You buy the damn haystack, and then you get everything. And if you think about the S&P 500 the last few years, the Mag 7 has made up 30% of the S&P 500. So, hey, if you're a sharp enough investor, kudos to you that you own those outright. But if you own the S&P 5 or you own the Qs, the reality is you had that exposure and you were able to garner that ability to find those best companies without having to pick them individually. But in a world where we see pressurized tariffs coming, when you see the haves and have-nots in terms of positive cash flow or negative cash flow, finding the companies that have true enterprise value, positive cash flows, a good outlook moving forward is going to be critical. Now, I think it's worth touching on the Mag 7 for a second because we're in the tech corridor. B, at 30% of the S&P 500, we are in the 100th percentile for market concentration over the last 100 years. And historically, that doesn't end well. You look at the Mag 7, they have delivered the last decade. Now, year to date, there is some real pain in there, but forget year to date. What I want to zero in on is the last couple of years and how we think about, this coming 2025 and looking forward. So looking at the bottom right, in 2023, the Mag 7 outperformed the rest of the S&P 500 by 63%. In 2024, they outperformed by 33%. We expect the Mag 7 to outperform again this year, but our expectation is they outperform by 7%. So you might say, hey, well, then we want to be overweight the Mag 7. What our research group would say is you want to own the Mag 7 still. We still believe in those business structures. But we would maybe say going overweight, we would argue now is the time to diversify. And I'll give you some thoughts why. One, we have an elevated dollar. The Mag 7 gets 50% of their revenues outside of the United States. An elevated dollar puts pressure on foreign earnings. And so when you think about a Mag 7 getting 50% overseas, and then you think about maybe a mid-cap US company getting 95% domestically, that can really drive a difference in earnings just given the currency value. Next, tariffs. Tariffs tend to push the dollar higher as well. Now, if tariffs go too far and crater growth, it can push the dollar lower, but moderate tariffs will push the dollar higher in most situations. That could be another pressure point on the Mag 7. You think about regulation. When we've had the S&P this concentrated, think the 80s with telcos, think the 70s with oil companies. What broke up that concentration was not ExxonMobil going bankrupt, was not AT&T going sideways. It was the regulators. It was the government coming in saying, you are too big, you are monopolistic, and we're going to begin to break you up. If you look at what's happened with the regime change in Washington, a lot is changing. One thing that is not is the SEC is still focused on the Mag 7 and the M&A they are doing and worried about that monopolistic behavior. And not just the United States. You look at Europe, they're doing the same thing. And I'd say one of the things we need to think about with tariffs is how are countries going to retaliate? And I'll give you two examples here. One is related to the Mag 7. for every dollar we put on a tariff on Canada, Mexico, China, it is 5 times more painful on their country than the same dollar tariff put on us. And so, said another way, you're not going to see other countries try to go dollar for dollar with the United States because it's a losing battle. What we expect to see is similar to what we see in baseball. If anyone's read the book Moneyball, think about the United States as the New York Yankees or the LA Dodgers. And think about other countries as the Oakland A's. You can't play by the same rules. You've got a completely separate balance sheet and you have completely different pain you can inflict with tariffs. So where are these countries going to target? Well, one, they're likely going to target our stock market, i.e. the Mag 7 and big tech. And so what are you seeing in China? They're already looking to come after and regulate Apple and Alphabet and some of our big tech names in China. And so if we want to go after China, they're going to go after our behemoths in the market and try to pressure our market. And so that could definitely have an impact on the Mag 7. And I'll come back to the Mag 7. The one other area in tariffs to watch, they're going to go after the red states. You're going to see things like tariffs on agriculture and crops in the red states to put pressure on the Republicans to try to get the White House to change some of what they're doing on the tariff side. And so this bears watching, but we expect to see much more targeted tariffs from other countries versus broad. Bringing it back to the Mag 7, 2 other thoughts there on potential headwinds to growth. And again, we're bullish overall. We're big believers in AI. But again, this is just talking about why to be diversified. Disruption. You look at DeepSeek that came out of China. And now just this week, Alibaba came out with another version of an AI ChatGPT. These are real competitors. It's a different way to do it. It doesn't mean our big tech aren't going to win at some level, but what it does mean is competition is only going to increase. And so that bears watching on the stock prices of the Mag 7. And then lastly is you go back and look at the tech bubble and look at Microsoft as an example. They grew their sales growth 10 and 11% during the tech bubble, and the stock was down 50%. So they grew their sales, but the stock was down 50. The reason why is investor expectations. As investors, we have a certain price on the stock. We expect a certain amount of earnings. And if that doesn't come through, we're going to feel it in the stock price, even if the company itself is growing. And so there's a number of hurdles or headwinds to some of the Mag 7 that for us, this is a market in equities and fixed income that we think diversification is going to really pay off. And year to date, it absolutely has. You know, if you look at the high in the market since February 19th, S&P is down 6%, small caps are down 9%, NASDAQ is down 9%. Believe it or not, Europe is flat and China is up. And so just looking at equities, you know, we don't necessarily think Europe is suddenly off to the races as a continent and going to grow expediently relative to the US. What we more generally think is the world of investors probably got overly optimistic on US stocks and overly pessimistic on global stocks. And you're just seeing a little bit of a reversion to the mean here. Now, jump into fixed income for a second. Let me go one more slide. Fixed income's been a pain point, right? Like the last 5 years, the US aggregate bar cap index is negative. High quality bonds haven't delivered a great rate of return. 3 years ago, they delivered a horrendous rate of return. What we are here to tell you is the value in fixed income is back. And how do you measure that? Well, one, if you look on the left, what we show you here is current yield relative to the median yield over the last 10 years. And across the board, high quality ag, municipals, investment grade, high yield, they're not cheap necessarily, in particular in high yield, but you are getting a yield profile today that is substantially better than 3 years ago. More importantly, you know, we were to have a recession hit, you know, again, we told you the long end of the curve, the 10-year treasury we think ends the year around 4.3%. If slower growth starts to get priced in and investors get concerned about recession, that 4.25 on the 10-year is going to go to 3, 2.5. And what that does when yields go down, your bond prices go up. And so when you look here, you can see income on fixed income is in the 90th percentile. Return asymmetry, which is a funky way of saying, are you getting value if yields go up and your prices go down versus the other way? The answer is yes. The asymmetric risk is back, and the capacity to hedge equity pullbacks is also back. You have a really solid layer of income and fixed income again that can serve as a ballast. And so when we look at this market and we think about how you want to invest, you know what? I thought I had a summary slide here. Apologies. You know, for us, it's a market that has positive growth globally, but we have a lot of policy concerns. And so this is a market we believe you want to stay invested in. Let's face it, the last few years, there has been a ton of concern for good reason in global economic events, in US policy, in elections. And if you were on the sidelines the last few years, it was a really challenging market to miss. This is not an environment we think you want to be high risk, full US equity long, but this is a market where we see good value in being really well diversified, picking up high quality income, and thinking about pockets of opportunity on the equity side. I'll end here just because this slide is up. Historically, we don't model commodities into our portfolios. They can be very volatile. But I would tell you, like, one area in commodities that we've liked is gold. You have central banks around the world buying gold. You have investors concerned about a ballooning US deficit. And one hedge that we think can make sense at the right level is a slice of gold. You know, again, it's something that historically is a good inflation hedge. It is a good currency hedge to the dollar if you're worried about dollar pressure. And so if you're thinking about something else beyond bonds and equities, gold is something that we have a 3,100 forecast on, which is a pretty decent upside, and as high as 3,300 in a bull case scenario. But hopefully this was helpful context as we're thinking about what is a fast-changing economic environment in the US. But again, the underpinnings of the US economy, albeit slowing modestly, still feel to be pretty constructive in Goldman Sachs' view. And again, you're in really good hands with Sequoia. Christina and team have their finger on the pulse in what's going on. And so if you have any further questions on this, happy to take them today, but know that you're in good hands. With that, Christina, happy to pass it back to you.
Okie dokie. I have a whole bunch of questions came from different sources, so I hope I pulled them together well. And then for all of y'all, stick around after the questions are asked and answered with a few other updates kind of outside of what Brian covered today. But really appreciate Brian. Brian and Goldman Sachs have been one of our great sources of economic data. As you all know, we use multiple sources, and some things will match along with their current viewpoint, and some things will be slightly different. And I'll talk a little bit about that and give you the whys. And as Brian mentioned, and as I've mentioned more than once, nobody truly knows the future. The most important thing is highest probabilities based on data and data alone, not feelings, not political bias, not most anything you'll hear in the media, but to focus very carefully on data and never be so rigid that we cannot adjust as the data changes. After all, our responsibility is your financial future. So it's very, very important. So go ahead and ask the questions out there. I thought, Brian, maybe we do is, you know, you can answer. I might throw some things in there as well, just so people can kind of hear some different ways of thinking of these things, if that's okay with you. And then that might get you out of here a little earlier too. Sure. See again, try to pull up different sources. Says, can Trump's policies offset inflation created by tariffs? What about companies in the US or moving to the US? I'll let you go first.
Can they offset inflation completely?
Yeah, they're basically saying that can Trump's policies, like his other policies or what he's doing, I'm guessing, this says, offset the inflation created by tariffs. And what about companies in the US which would, I would assume, and I'm just going to fill this in myself, would benefit, of course, from tariffs potentially, or companies moving to the US. So I get what that question more so is that what are these policies build to offset the effects of tariffs to reduce the cost to consumers? Well, maybe I shouldn't call it inflation. They put inflation, but we'll call it cost to consumers.
So tariffs won't reduce the cost to consumers. Most of this will get passed through. Could it reduce the deficit? The answer is potentially, but right now the plan put forth by the Republicans is about a $4.5 trillion budget. The cuts are only $1.5 trillion. So that is a really wide gap to try to get the current policy that the House would like to pass through. And the problem with that is they're going to have to go through what's called reconciliation to get any policy through in the near term. Now, the Republicans, if they got every vote, they can do it in their own right. But obviously, there's a pretty disparate view just within the Republican Party, although Trump's really trying to toe them in line. So like, what would that look like? The reality is they're not going to be able to do a permanent policy. Permanent policy requires debt revenue neutral over 10 years. With a $3 trillion gap, it's impossible unless they're going to go after Medicare, which just isn't going to happen. And so that's where we look at this. You're more than likely to see a 4 to 5 year plan, probably a 4-year plan that we're seeing, which isn't permanent, where then they could implement a lot of these policy changes. It could help with the deficit modestly, but the reality is with the Trump tax cuts and a lot of the other things that were promised during the election, they're not going to shrink the deficit. If anything, they're trying to get to debt neutral. And even right now, like they don't have it printed. So we'll have to see how the policy plays out. And I hope I answer your question. But the reality is like, no, I don't think tariffs are not going to solve for that. They could help. But right now, the plan, there's just way too much deficit getting built for the tariffs to solve for all of that.
Okay. And I'll throw in just a little other piece to this, just depending on how you read this question. My understanding of what his administration is trying to do in this respect is to bring more business to the United States and grow the US economy more organically as opposed to through debt issuance, right? As we've had the last couple of years, those big government spending has been driving the economy. Whether or not that's successful, I at this point feel is very unknown because there's, as Brian has mentioned, there's a lot of unknown variables. So to say it's going to be a big failure or to say it's going to be massively successful is more political bias than it is necessarily hard data on the ground. Interestingly, it's not a whole lot different than what President Biden was doing with the CHIPS Act and other things he did during his term. With the idea, the difference is it was more fueled by government debt than it was fueled by bringing companies home. But the concept was build it in America from national security and economic security standpoint, especially with chips, but also the idea that would create more prosperity for more people over time. So just two different ways of doing the same thing. But yes, I think what Brian said is really, really important with everything happening, with Doge, and I'll talk a little bit more about that afterwards, and everything like that is really, it's more just to get that 2 trillion balanced. It's not to solve the 36 trillion. It's just as a massive undertaking. You've heard me say this multiple times. The major spending of the entitlement programs, over 2/3 of the government spending, and there's no world in which they're going to cut those programs meaningfully. I'll talk more about that later, but hopefully that was just, again, added a little bit of a flavor to that. And this is going to be an ongoing story. And I want to add also too, my apologies. Some of you may not be familiar with the term Mag 7. So I just wanted to kind of go further with that. When Brian's mentioning Mag 7, he's mentioning how much of the S&P 500, the stock market, is 7 companies. 7 companies, you've probably heard many of their names, right? With Meta, with Google, with Apple, etc. So the idea of that concentration, but I just wanted to really define what Mag 7 is for those of you that might not be familiar with that term. And doing that. Okay, next question. How much does reduced government debt spending impact the economy? Actually, sort of answered that earlier, but basically, how much is if the government reduces its spending, how much does that impact the economy? I'll let you answer first.
Yeah, I mean, the reality is they're not reducing their spending as the plan stands right now. A reduction in spending, I mean, it'll bring down the deficit, which is positive. It can create frictions in the system depending on where you're pulling from. So ideally, we need to bring down the deficit, but is it all positive? I think it depends where you pull from. Right now, what you're seeing is more they're trying to figure out how can they get through the tax policy? How can they get through the change in regulation, to Christina's point, to bring companies home? These tariffs are very targeted. They're trying to, frankly, they think the White House looks at current trading agreements as unfair. And they're trying to make sure that they get a fairness aligned across all of these tariffs with both our trading partners and our adversaries. But if they are able to bring down spending quite a bit, it probably slows growth modestly, as the US government is a huge spender in the system. It could affect asset prices on the margin. But right now, I mean, they're just not in a position to bring down the deficit massively. I think DOGE could certainly help curtail costs within the government. But until we see the plan from the Republicans and where they're going to really curtail the deficit, right now it's just not in the outlook we see for 2025 in a big way.
Okay. I think that was a great answer, and I should be able to add to that. Just adding a little bit to what he said about it depends where. It depends where. So just because the government's spending doesn't mean that money is flowing into the economy, right? So notwithstanding, fraud, money just disappearing overseas or anything like that, but actually true legitimate government spending, it all depends on where it is. And not to say that all the government money should be spent on economic activities. But there are some that are more productive for society than others. And there are also some that are necessary as a social necessities, security and whatnot, or I say the social benefits programs. So the addition to that is it just depends what they cut and where. And sometimes it's things that are a little bit beyond our control. For example, conflicts overseas, support overseas and things like that may not be something the government necessarily wants to do, but feels that they need to do for the protection of our country or our allies. Okay, a couple more here. Fewer immigrants to more unemployed government workers. What is the impact? And it said employment. I think this was back when you were doing the employment, talking about that. So you're talking about that flow of jobs and workers available to do the jobs. And then we have a situation where there are a lot of illegal immigrants, being deported, and there's also a lot of government employees that are losing their jobs, even though the numbers of government employees are a fraction of what was hired in the last couple of years. But basically as a question, what impact would that have to your models, or is it already in your models?
Yeah, at like the country basis, it's a very minor impact. We're talking 0.1, 0.2 to the overall unemployment rate. So right now we're at 4.1, could go to 4.2, 4.3. Like that's not where you're going to see the impact. Where the impact is going to be is isolated in the industries where a lot of the undocumented work. So think agriculture. Like our food prices could go up rapidly. Napa is scared to death about how they're going to manage their wine crop because most of those workers are undocumented. And so hospitality, major hit, as a lot of workers there are undocumented. Food industry. So it's going to be more precise on specific industries where you're going to feel that labor pressure, much less so at the broader economic level.
Actually, I'll throw a question there for you because I don't know the answer to this. So there's different levels of the, deporting undocumented people. One is, as they're saying now, the criminal element, right? Which is, I'm sure is a relatively small percent of the people that are here undocumented. So is factoring in just, if it's just the criminal element being deported, it's a more minor. And if it's everybody that's here undocumented, then that's when you start to see that massive impact to say agriculture and places like that.
Yeah, I mean, look, we'll see how far the White House is able to take it. The reality is the amount of manpower it would take to remove every undocumented immigrant, it's literally impossible. So we think they're going to probably target more, again, kind of criminals up front. But, it's a little bit of an open question in how far they target it. I think going back to the part about government workers, like, again, regional, not just different industries, but also regionally, there's going to be major impact. You think about Bethesda, Maryland, it's going to feel like a recession. If you've got a huge government workforce in a small town and there's layoffs there, it is going to be felt across that community. And so there's going to be acute pain, in our view, less so broad pain based on the current plan right now.
Okay, thank you. All righty. I think you answered this, but I'm going to ask it because it's kind of a question here. Are not the tariffs actually a tax that is paid for by consumers?
It typically is. Yeah. Usually the corporations pass that through to the consumer and we see it in higher prices. And so that's our anticipation. That's what most corporates have said on their latest earnings call is they anticipate passing most of that through. So frankly, that's why you see our growth print down from 2.5 to 1.7. The consumer is going to be spending less. Profits are going to be, or growth is going to be slower. You're going to see CapEx slow as corporations are maybe a little bit hesitant, especially if their industries in the crosshairs of potential tariffs. You're probably going to see CEOs say, hey, let's wait to see how this play out versus putting some money in the ground today. So you're already seeing it impact just the psyche of corporations and individuals.
And I'd add to that, if it's, there's different ones. Sometimes we notice every time there's an economic event that where prices can rise, everyone says, oh, it's a supply chain issue, even if they don't import anything, right? It's an excuse sometimes to be able to raise prices. So not all of the price increases may be legitimately tied to tariffs. Also, there can be US companies or companies that source everything in the US that could benefit. I recently saw something from, I think it was Budweiser, of all places. They're just like, yes, right? They're almost entirely in the United States. So you're seeing that with some of the like the steel producers, aluminum producers in the United States. You're seeing positivity in US based companies. So it'll be the challenge is the supply chains are set and they're expensive and difficult to move. So if you got your supply chain and it's all set up, and all of a sudden, you say, oh, we got these tariffs on Mexico. It doesn't make sense to have our supply chain in Mexico anymore. We got to move our factory to the United States. That costs a lot of money and takes time, like a lot of time. That's assuming you can get all the workers and everything. So when you have a rapidly changing tariff environment, which is tariffs on, tariffs off, maybe tariffs, this kind of tariff, not that one, it makes it really hard for companies to take action when they have a physical location that has to move our supply chain. So I did want to add that is some companies can change quick, like a lot of tech, but not when you got a factory somewhere. So that's where this is. There will be winners and losers, and that's going to be a very important part of investing in your portfolio. Is not reacting to the news, but reacting to what's actually happening in company levels. Alrighty. Do you have any indication that there's any pushback on the part of the Republicans, re Trump's policies? Also, what do you view will be the impact of fewer immigrant workers? I think we already talked about the immigrants, so we'll go with the first part of that. Do you have any indication that there's any pushback on the part of Republicans to Trump's policies? I'll let you go first.
Look, yeah, I mean, there's some pushback now. We'll see. I mean, they just looks like they're gonna push forward with a full Republican plan to not stop Congress. And so if they can get that done, it shows maybe the Republican Party is getting more in order than what they have been the last couple of years. But there's still very disparate views of possibly the Republican Party. You think about the Freedom Caucus that really wants to reduce the deficit massively, yet you have a White House that's expanding the deficit. And so how they're going to come to a compromise there will be really interesting to see. Can they get to one without needing to involve the Democratic Party, which then will involve different pieces that the Democratic Party want to see to get everything through. So absolutely, there's already pushback as it relates to the deficit. I think what also is going to bear watching is, if you're a congressman or senator in an agriculture state and you start to see massive tariffs put on by other countries, your constituents are not going to be happy. And so they're going to start calling the White House saying, hey, what's going on with these tariffs? Are we really keeping these in place? Because my constituents are taking the brunt of the pain. The rest of the country isn't feeling it. So absolutely, you start to see the heat get dialed up depending on where tariffs fall. And as the deficit falls, already there's a lot of debate and consternation within the Republican Party. So the pressure is going to be there. What's going to be fascinating to see is, can Trump kind of drumbeat them all in line? Or do you start to see things fracture over time? So far, they've held the line pretty tight year to date, but it's a long year and a long 4 years, and we're just a few months in.
Yeah, I would agree. And we've seen this in past administrations too, especially when they've had a majority, where they've been like, mandate, we're doing it all our way. And in the beginning, that flows, right? And this has, again, been Democrats, Republicans, different various administrations in the past that we've seen. And then the cracks start to show. And it usually starts with the people saying, I am affected by this. You need to do things differently. And as Brian mentioned earlier, if countries can't really compete with us economically, and countries can't really compete with us on tariffs. They just simply can't. If we wanted to, we could get a lot meaner. We could really essentially destroy their economies as a nation. And I'm not saying that to be mean. I'm just saying that's economic reality. So what they're going to do is they're going to say, how can we create the most pain with the power we have? And so as Brian mentioned, if you target ag or something like that, then you could see that pushback from the ground coming to the Congress people, and then they're going to the administration. And again, this has happened before. This has happened for previous administrations. It's not really specific to what's happening with Trump or with current times. This one I'm just going to comment on. It's not really so much a question. Is Social Security is not an entitlement. We have paid into it through our lifetime, and I just want to clarify that. Entitlement is the official government name for these programs. They're called entitlement programs because you are entitled to them. It's not the word entitlement, which is commonly used today, which is you're an entitled person. So I hope I'm explaining why we're using the word entitlement program. That is a government word for these programs because you paid into them, you're entitled to them. So just clearing that up. It is the official word for those three programs is entitlement, but I know that word can sometimes not have the best connotation to it. Okay, final one here. I don't think you can answer this, and I don't know how much time we have to answer it. So I might tell this person to ask this question on a private level, which is not accounting for Elon Musk and the politics. Is Tesla a buy, sell, or hold?
At the stock level, I can't give advice. So unfortunately, I'm going to punt.
I know. I figured, but you know what I said? I promised we'd answer every question. So I hope I didn't miss any, because I did sort of consolidate some of your questions together just to be able to get, like, in the interest of time and getting it all done. So that being said, yes, and I would actually, on this question about Tesla, this is a really, really individual question, and it really depends on your specific situation. What you're trying to achieve, your time horizon, risk tolerance, etc. So definitely a question to ask us individually, or if you don't want to talk to us, your advisor, if you have an advisor elsewhere. Again, very individualized. So that being said, I'm going to hang out here for the last 10 minutes we have and just touch upon a couple of things real quick. Brian, you're welcome to go or stay on. I'll leave that up to you.
Well, thank you. No, thank you, Christina, for having me. It's
you're
been
welcome.
a pleasure.
Thank you.
And thanks for everyone for taking the time today. Hopefully you learned something. That's the goal. And know, again, you're in great hands with Christina. So thank you.
Okay. Thank you, Brian. Have a good afternoon. Well, that was a whole lot of information, a short time, very detailed, kind of more, I don't call it in the weeds, but some of the answers to some of your questions was really great to hear from a different thought and opinion. Now I do a lot of my own research and I use a lot of different sources. So there are a couple of areas where my projections as of today, subject to change tomorrow, are a little bit different than what you heard today from Goldman Sachs. So I'm going to cover that in an upcoming webinar so that I have an opportunity to really go into more detail on why. We're not hugely different, just a little bit more of a growth prospect for this year. Biggest thing I really want to address the questions I'm beginning the most. While the economy will slow, at least in the near term, the second half is still looking pretty strong. So whereas Brian with Goldman's outlook was kind of a little more looking at the entire year, the slowdown started at the end of last year. Based on data, we're getting the economic data, so this is not a projection. Slowdown started at the end of last year. It's going to play through the beginning of this year. It was already in motion before the Trump administration took office, and it was entirely from the slowdown in the government spending. That was it. Just that money's not being pushed into the economy. It's just it's naturally a lot. If you recall, I'd mentioned to you last year that I expected to slow down the economy late in 2024. And that didn't materialize. And I said, why? I said, we just keep getting all this government money. It's kind of boosting things longer. That being said, that dried up, right? Election time, the politicians are focused on the election. Nothing's getting done in Congress. Then the election happens, change in administration. So the effects of that were already being felt in fourth quarter. And again, we're getting those reports already from the end of last year. This quarter, same thing. Now we have the added newness of the new administration moving very, very fast. Whether you agree or disagree or love them or hate them, they're moving quick. And moving quick, while could have great benefits in the future, and could have not great benefits in the future. And I'm talking economically here. I won't get into the social or political aspects of it. We don't know. A lot of opinions out there. Most opinions are biased to some degree. Nobody knows. Here's what's the most important thing to know. We're paying close attention. When things happen, we separate as very much like what the Fed says, the wheat from the chaff. Sorry, the signal from the noise or the wheat from the chaff, depends if you listen to the Treasury Secretary or the Fed. But the idea of what is noise and what is legitimate, and what will actually have an economic impact and what will have more of a social or political impact or effect, right? So separating this out takes work. Then we get earnings from companies, and we can more closely drill down as who is benefiting from the environment we are in today and who is not, and how that take effect. So will the costs of goods be mitigated because more things are built in the United States, or US companies are able to be more competitive? Or will it lead to a spiraling trade war where it's tit for tat, tit for tat, tit for tat? And that will actually be something in flux, and it's going to be very much on a company level, which is why this is a time to be very tactical, but not reactive. The other thing is inflation is likely to bump up more. It's going to likely slow for a bit, and then it's likely going to come up later in the year, regardless of tariffs. Okay, so as Brian mentioned, the numbers might be slightly higher, but regardless of tariffs, that has a lot of these things have been in motion for a while. Originally, inflation was going to pop up earlier in this year. It's been pushed out a little bit just because of what's happening in the economy. So it is coming back. Doesn't at this point seem to be an out of control situation. It's going to be a little bit higher before it starts to level off into next year. So late this year, early next year, inflation likely to be higher. This is important in a planning perspective. So it's something really important to talk to me individually about. At our event in April, it's a live event, April 21st. We'll also live stream by Zoom. So if you can't be there, make sure you register, get the recording. We're gonna have a live event. We're gonna have speakers there. We're gonna really get into some more detail from a planning, like what does this mean to you? How do you want to plan around this? Because it's going to provide opportunities a lot, and it's going to provide challenges to navigate. So that is why this time period is going to be that way. Brian did mention gold. Many of you have it in your portfolios in various holdings. It's not right for everyone. So this is definitely something to talk at an individual level to see what and how you may or may not want to hold that. And just again, I'm trying to cover a lot of these things really quickly here. And getting into all of this is that with all the uncertainty in the world right now, it is really always uncertain. The difference is right now it's noisier. It's louder. You can hear it because the current administration likes to get in and make noise. And again, whether you love them or hate them, that's what they do. They're just going to get this done. And it's going to create disruption. This outcome of this disruption is, when I say it could be very good and it could be challenging, is also going to be something that's going to be very individual. So I want to break that into, I'm going to tell one quick thing and I'm going to break this down. Talk about Canada. I've gotten a lot of questions about Canada recently. Canada has a new premier. He was elected by his party because of Trudeau stepping down. So Canada, let's just make it simple. Conservative Party, Liberal Party. The Liberal Party picked him. He's now leader of Canada. What happened in Canada recently is Trudeau became very, very unpopular, and the Conservative Party was up double digits over the Liberal Party. Since the tariff, let's call it the tariffs have begun, or the tariff talks have begun, the Liberal and the Conservative Party have actually evened out quite a bit. So the tariffs are actually very good for the Liberal Party, who Carney is the head of now, to win in the elections that are projected to come up later this month or next month, I believe. And so right now, it's actually Canada is really going to be beating the tariff horn as much as possible, because the more they say, we're going to get that US, then the stronger it makes the current ruling party. So you will also remember within countries is there are their own, it's not all about us. There's things happening within countries that are going to cause leaders to take different positions for their own political future and for their party's future. So never forget we have that element in there as well. So I would expect the next month or so before the Canadian election, we're going to be hearing a lot more from Canada about because it's essentially an election season, for lack of a better term. The other thing I wanted to bring up when I said, these things can be positive or negative is those are two elements. Number one is how you manage your financial life, your portfolios, the guidance we give you, the advice we do, the management of your portfolio, all right, to navigate this situation and look for the highest probability of success. The other one is you and how you navigate this on I call it the mental, spiritual, emotional level of this, however you define. Some people, when there's a lot going on, it can be very stressful. could be very concerning, it could be very difficult to navigate, especially if you're watching a lot of news, social media, etc. For others, change doesn't bother them. They're like water off a duck's back. It's like, okay, whatever happens, I'll be fine. And don't get too attached to the outcomes. So the only thing I can bring to that is that there are 2 elements. Some elements, we can certainly help with. That is our goal. We want the highest probability of you being successful in your life journey. That is our intention at Sequoia. We work very hard to do so with all of the financial aspects, and as many of you know, even beyond that. But the other thing is for you also to just, I would say almost for lack of a term, embrace the fact, because it's so much better than resisting and fighting it, that things are going to be a bit different for a while. A lot of things that used to be done quietly behind closed doors are now being done out and loud. And that can create stress for certain people. It's not even just political, it's just the whole idea of the changes. So I wanted to bring out there is that if you have concerns, if you have worries, if there's something that you're like, oh my gosh, is there something we should do? Please do not hesitate to reach out. We will do our very best to help you navigate this and any other things that are happening, whether they're personal life events and changes, things happening in your family or your social community that could maybe impact some of your decision making on your state level and on the federal level and on the international level. All these things that you say, hey, does this have an impact on me? Please do not hesitate to reach out. We will do our very best to get all the answers for you and to give you peace here as well as peace here. So that being said, I know we're running up to the end of our time together here today. I want to see just really quickly if there's any other questions, and then encourage you. Sorry, I'm just going to double check on the question side of it. So I wanted just to encourage you, if you can, we'll be sending out the invitation shortly for the event on the 21st. It will be held in Santa Cruz at the Hotel Paradox where we did it previously. If you cannot make it, we have multiple speakers there. It's going to be a fun social event. Definitely do the Zoom. And that will give an opportunity for you to get, again, more updates. This may be an environment, again, where you want to listen to more of these. Finally, if there's something that is really interesting, something you want to hear more about, something you want to know, please let me know. I will find the speakers. I will bring them in. I will talk to you about it myself. I said I was really trying to find a conduit to bring really good information out there. We strive to be optimistic and positive because that is the energy you use to manifest to you and to ourselves. However, we're also going to be upfront and real with you. So when things are slowing, we're going to tell you. When there's action to take, we're going to tell you. We'll also, though, cut through the news and a lot of the things out there that may be interesting. They're not really relevant to your specific plan. So with that being said, thank you all very much for coming today and listening to this, or whenever you listen to the recording, and look forward to seeing many of you on the 21st. Bye for now.